everyone, my name is Emily and welcome to another educational video. The word Goldilocks is a reference to the popular children's story Goldilocks and the Three Bears. The term is used in finance to describe an economy that is just right with steady growth and normal inflation. It is an ideal economy that is not too hot and not too cold. In other words, it is a Goldilocks economy. In this balanced and healthy economic system, there is full employment, economic stability, and steady growth. The economy is not expanding too much to push inflation too high, and not slowing down to enter into recession. A Goldilocks economy is also good for investing and trading. In a growing economy, companies also grow and generate positive earnings, resulting in their shares performing well. Goldilocks economies are temporary in nature because there are boom and bust cycles. While there may be disagreement among economists about what the exact characteristics of a Goldilocks economy are, the basic idea is that there is a balance between growth, employment, and inflation. The ideal conditions for a Goldilocks economy are low unemployment. Unemployment is measured with the unemployment rate, which reflects the number of people willing and able to work but unable to find gainful employment and who have sought work in the past 4 weeks. The Federal Reserve estimates a normal rate to fall between 5% and 6.7%. Another condition for a Goldilocks economy is asset price inflation, which refers to an increase in prices of shares, real estate, derivatives, bonds, and other assets. Low market interest rates and low inflation are also important, as well as a steady gross domestic product. The GDP is the most essential indicator for a Goldilocks economy, as it measures the value of all services and goods produced in a country and reflects the health of an economy. For example, a negative GDP in 2 consecutive quarters indicates a recession. On the other hand, a sharp increase in GDP can push prices too high and result in high inflation. An example of a Goldilocks economy is the US economy of the middle to the late 90s, but also the US economy after the bursting of the dot-com bubble between 2004 and 2005. Thank you so much for joining us today, guys. See you soon. Bye-bye.
Okay, let's go ahead and get started. So for today, we're going to be looking at news trading and how you can implement news trading into your trading strategy. So before we get started, just a risk warning as well as the disclaimer. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Free distribution of the material is strictly prohibited. Okay. So I'm Melanie and I will be your speaker for today. I am an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in 2019, 2020, and 2021. Okay, So here's our agenda for today. We're going to be looking at the basics of news trading, and then key news events to watch out for, how each news event affects the markets, and then news trading strategy. So after we've gotten through the slides, I think we'll still have a bit of time left. So we'll go ahead and take a look at some setups. So feel free to let me know in the chat throughout the webinar if you have any questions or any requests for any setups you'd like me to go through. Okay, let's get started. So firstly, we're going to be looking at the importance of fundamentals. Excuse me, along with the importance of trading the news. Okay, firstly is the awareness of key events. So an economic calendar keeps you informed about important economic and financial events, such as central bank announcements, economic data releases, and, and geopolitical events. So this awareness helps you to stay ahead of significant market moving events and their potential impact on the financial markets. Number 2 is market timing. So what we mean by this is when you know the timing of upcoming economic events, you can then adjust your trading strategy and position yourself accordingly. So for example, if a major economic data release is scheduled, you may decide to wait for the announcement before entering a trade to avoid the potential volatility or price fluctuations associated with the release. Next, volatility management. So this is pretty straightforward, but economic events often cause increased volatility in the markets. So by using an economic calendar or taking note of the news events, you can then anticipate periods of heightened volatility and adjust your risk management strategies accordingly. So for example, you may decide to tighten your stop loss levels or reduce position sizes during volatile events to manage your potential risks. Next, fundamental analysis. So there are a lot of indicators that you can use, not just economic calendars, and data releases as well. So these indicators offer insights into the health and performance of various economies and sectors. So by incorporating fundamental analysis into your trading strategy, you can make more informed trading decisions based on the underlying economic conditions. Next, trading opportunities is pretty straightforward, so I'm not going to get into that. Avoidance of surprises, pretty self-explanatory, but this basically helps you to avoid being caught off guard by unexpected market movements, and it also enables you to make more proactive and informed trading decisions. Risk management, we already talked about. Reducing your position sizes, increasing stop loss levels, even temporarily exiting the market during high risk periods are all examples of risk management. So lastly, long-term planning. This allows you to plan your trades and investments with a long-term perspective. Because when you incorporate anticipated events into your trading strategy, you can then align your positions with the expected market trends and take advantage of long-term opportunities. Okay. So an example of this, of keeping up with the news, you can use the FX news calendar. So we have a couple of examples here, but some of these benefits include allowing you to see at one glance all important economic data releases. So this is really useful. Let me just show you guys what is the website that we like to use. So on the left here, we have investing.com, and on the right, we use Forex Factory. So we typically prefer to use Forex Factory. Okay, let me see if you guys can see my screen. Okay, yeah. So, of course, both are good, but for Forex Factory, which I have over here. You can adjust the day and you can take a look at the upcoming events for the week. You can also apply settings, and then you can filter the expected impact of these events as well. So more often than not, I prefer to just look at the red calendars, because those tend to have more of an impact. But of course, maybe I'll just show you guys. Yeah. So these include the CPI, employment rate, important data releases like that. Orange and yellow tend to include most FOMC members' speeches, as well as PPI. Yeah, so it includes all of the events for that week, as well as the previous data releases and the forecasted data release. Then it will update the actual amount or the actual data. So based off of these events, as well as the forecasted data, you can then make more informed decisions when you are deciding on a trade. Okay, let's get back to our slides. So one thing I will note is that it's important to distinguish between microeconomic and macroeconomic activity. So some news may impact particular cities such as Tokyo in Japan or Dallas in the US. So in other circumstances, a country like Germany may benefit or be hindered by economic news more than its neighbors. So for example, if there's an announcement by the ECB, it's likely to have a greater influence on Eurozone markets than those of African nations. So we want to keep track of the leading economic index or range of composite indexes, such as the coincident index of major economies. Then we use the information that we have at hand to help us to gauge the economic sentiment and volatility levels of the instruments that we are trading. Okay, so you can see here, these events, all of the major events include GDP, CPI, NFP, crude oil inventories, and central banks' monetary policy meetings as well. Okay, so there are four main factors to consider when you are trading the news. Firstly, news event to pay attention to and the expected data. Next is the price reaction from the previous news release. Because as I mentioned earlier, you can obviously look at the previous forecast, the previous data release, and you can pull out your trading view and observe how this data affected the market. So once you observe that, you can then look at the current trend as well as your support and resistance levels that you intend to place as your perhaps your stop loss or your entry levels, or even take profit levels, to prepare yourselves for any of these upcoming events. Okay, so here's an example. This is from last year, but on 7th June, there was a 50 basis points hike. You can see, notice the effect of this data release on the market. And then on 5th of July, another 50 basis points hike, and price continued to drop. Even though it did continue to rise in between, perhaps because of a forecasted release that price is likely to not increase anymore. But you see, after this data release on 2nd of August, price continued to drop. So you can see, after each 50 basis points hike data release, price continued to drop for each of these. So regardless of what happened in between these two events, price always dropped after the data release. So this is what we mean by observing the previous data and then comparing that with the financial markets at that time. because it's likely to enable you to forecast what's likely to happen in the future as well. Okay. And then we see here on the 5th of July, excuse me, you can see this huge drop in the price after the data release over here. That's why it's so important for you to take a look at the previous data as well. And you can see here we've highlighted the support and the resistance levels, just so that you can see where exactly you should place your stop loss as well as your take profit right before any data releases, just to make sure that you are well protected regardless of the outcome. Okay. Oh, here's the 2nd of August 50 basis point hike as well. Once again, we've highlighted the resistance as well as the support levels over here. And you can see over here, the support level, even the price increased as we saw in the previous chart, over here, our support level is at this multiple swing low support. So we can see, so we decided to place our take profit here and our stop loss level over here at the swing high. And you can see once price continued to drop down, we expected price to reverse off of this level. Why? Because we have previous data, or rather it shows us that price has reversed off of this level multiple times in the past. So price is likely to reverse off of it once again. Okay, let me know if you guys have any questions so far. Okay, if not, we'll move on to our next part. So key news events to watch out for. And we'll also be going through what some of these events mean and what they represent, and why exactly they're so important. So there is a theme of economic focus. So the news events, for example, the global financial crisis, the period was from 2008 to 2009. So in this case, the economic focus was employment data and wage growth. During the COVID pandemic from 2020 to 2021, the economic focus was to increase GDP. Currently, or previously, our news event or the current news event is looking at predicting when the recession will occur. So some people are thinking that we are currently in a recession. Some people think it hasn't happened yet. But our economic focus at the end of the day, whether you think it is currently happening or not, is the inflation data as well as the interest rates. So this is what the governments are controlling. So this is our economic focus currently. Okay, so what exactly do interest rate decisions mean? So central banks hike interest rates to increase the cost of borrowing. This slows down economic activity. It also reduces and slows down the speed of inflation growth. This is also a high price volatility event. So every time that we see that there is an interest rate hike or interest rate decision coming out, then you can anticipate a high price volatility event is about to occur. I'm so sorry about my throat. Okay. Okay. So next, let's look at non-farm employment change or non-farm payroll. So this represents the change in the number of employed people during the previous month, excluding the farming industry, and it also excludes a couple of private industries as well. So the job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. So the NFP data releases are also considered a high price volatility event. Okay. Okay, so let's take a look at some other high impact events as well. So this is mainly for US events. FOMC meetings are Federal Open Market Committee meetings. And this is the US Fed's way of communicating their view on monetary policies. The Fed interest rate decision normally comes together with FOMC meetings as well. If the Fed is dovish, then the USD is bearish. If the Fed is hawkish, then the USD is bullish. If interest rate goes up, then the USD is bullish, and if interest rate goes down, the USD is bearish. So just some explanations for on some finance jargon over here. Okay, we have briefly talked about this already, but unemployment rate as well measures the total unemployment of workforce that is seeking active employment from the previous month. Okay, crude oil inventories measures the weekly change in the amount of crude that's held by US firms. Now, if the crude inventories increase, then we can expect oil prices to drop. And the EIA short-term outlook is the monthly forecast for the year ahead, the demand and prices across major fuel types. Okay, inflation data, CPI, measures the change in price level of a basket of consumer goods and services. It also indicates the change in cost of living. So the target CPI for an economy is typically between 2 to 3%. Okay. So this is the news events for this week, between July 17th to July 21st. And this is solely looking at the high impact events. Okay, so just a reminder, we want to look at news events to pay attention to and expected data. Number 2, we look at the current trend. Number 3, support and resistance levels. And number 4, price reaction from the previous news releases. Okay, here is an example with all of the events. Okay. So on this chart, we see the impact that it has on right when data is released at this timing. We see price steadily increasing, and then once the data was released, price immediately shot up. And we placed our stop loss over here at this swing low support level, and our take profit at this swing high resistance level. Okay, and you can see price steadily increasing, but it doesn't reach our take profit level, but you can see that it went down and it's continuing to increase. This is because of all of the upward pressure that's over here. We have not a trend line, but we have a upward direction over here. Okay, here's another example. You can see exactly when the data release was released here. And then you can see markets are kind of apprehensive about the data release. And then right when it's released, it's shot up. Okay, so we're just taking note of the support and resistance levels between all of these price charts. Okay, next, how each news event affects the markets. So firstly, let's start off with the short-term effect. So the short-term change in price depends on existing trend. Firstly, we have the employment change. Secondly is the retail sales. And thirdly, purchasing managers index, which is the PMI. The medium to long-term effect events have a potential to change or reverse in trend, and these events include GDP, inflation data or CPI, as well as any interest rate decisions. Okay, 3 news trading strategies for you guys before we get into looking at our charts for today. So firstly, entering before the release. So this would be typically on the shorter time frames, either the H1 or M15. For the pros, you can catch the maximum move. Cons, you could get spiked out immediately. If it does the opposite of what you predicted it would go. Next, pending orders. These you're looking at the H1 time frame. Pros, there's less emotion as price moves, so you won't be so anxious at the time of the release. Cons is that there could be a price slippage. Next is reacting to the release. So this once again is another short-term trading strategy on the M15 or either M1 even. So either the 15-minute or 1-minute time frames. So the pros is that you are trading exactly what you can see, but the cons is that it could get influenced by price movement and it could be pretty or your charts can be pretty noisy since you are trading on such small time frames. And typically after a data release, most traders tend to get really excited or their emotions come into play. So it could show you, it could get or the price charts could get very volatile, especially when you are trading on the smaller time frames. Okay. We briefly touched on this already, but just recap some of the benefits of using an FX calendar. It really depends on whether you are a long-term trader or short-term trader. But we've shown here a couple of trading strategies for you to use, even if you are a long-term trader. So yeah, it generally helps you to be alert to upcoming important news that may affect the volatility as well. So trading on the 1-minute reacting to release. Okay, sure. So for over here, we typically wouldn't recommend trading on the 1-minute because, for example, if I showed you guys the charts on the 1-minute time frame. Okay, these charts are pretty clear currently. But the danger with trading on a 1-minute time frame is that it can get very noisy and quite difficult to trade on if you don't know what you're doing. So we typically wouldn't recommend that for beginners, especially after a news release. So in this case, we're talking about reacting to the release. So after a news event, these charts tend to be pretty even noisier than what you see here. So this is a pretty clean chart, but after news release, they tend to have a lot of noise, especially on the 1-minute time frames, 1-minute as well as 5-minute time frames. So it can be quite difficult to analyze your support and resistance levels because they can move pretty quick. As you can see here, if I've placed, for example, earlier, if I placed my okay, before this was formed, there was kind of a okay, maybe here. So I have a support level here and then a resistance level here. So the thing about trading on a 1-minute time frame is that you have to be really fast and really concentrate on the price movement. So you can see my candlestick is already forming here. So this is good for scalpers as well as if you are a short-term trader, because it's likely to reach your take profit and stop loss pretty quickly. But the strategy is exactly the same. So after the news release, if you are expecting it to go up or down, and you see price looks like it's heading downwards, perhaps then you could place your take profit exactly where price is headed to, and then get your take profit over there. But of course, as we mentioned, the price, there are a lot of cons to this. It could get influenced by price movement. So if price, obviously you won't be the only one who sees price dropping and wants a slice of that. So if price continues dropping and everybody is going in for the trade, then it's likely to reverse, or it could reverse, since there are so many traders who are influencing the price movement. Yeah, okay, I hope that made sense. Okay, but now let's get into some of our setups for this week. Okay, I got a request for pound dollar, so we'll go ahead and get into that first. But feel free to let me know in the chat if there are any other requests that we'll do those after pound dollar as well.
I think it should be like Friday out.
Okay, so when we analyze these charts, we won't analyze on the 1 minute, 5 minute, 15 minute, because of there tends to be more noise on these time frames. So we will look at either the 1 hour or the 4 hour time frames. Okay, let me just clear my charts first. Okay, so before we analyze on the 4 and 1 hour time frame, we'll first take a look at the higher time frames, just so that we get a general direction of where prices are headed. Okay, so here we have our weekly time frame, and on the weekly time frame, we can see prices headed upwards. Okay, let's take a look at our daily time frame. Daily time frame is also giving us a very bullish signal. We have a trend line here. Okay. Okay, now let's take a look at either the 4 hour or 1 hour time frames. So how we decide between 4 or 1 hour is by looking at how clear the charts are. Okay, in this case, both of these charts are pretty clear. So I'm just going to go ahead and analyze this on our 4 hour time frame. Okay, let's see, we have a trend line here. Let's see if we have a ascending trend channel. Okay, not really. Okay, but we have this ascending trend line here. Remember, for a valid trend line, it has to touch 3 points, at least 3 points. So here we have 1, 2, and 3 points. Okay. Now let's go in with our support and resistance levels. Okay. So to begin, here is my first resistance. This is just graphically, so we will adjust it accordingly later after we have included our support and resistance levels. Or rather, then we'll go in with our Fibonacci levels and then adjust the levels accordingly. So that's my first resistance, and then here's my first support, and here is my second resistance instead. Okay. Okay, now that we have that, I'm gonna go in with some Fibonacci levels. So here I have a Fibonacci retracement first. And for Fibonacci retracement, we are using these 5 levels. So 23.6, 38.2, 50%, 61.8, and 78.6. Okay. Here we can see that the 23.6 and the 50% lines up with the first resistance and first support. So these don't really have to line up exactly because Fibonacci confluence levels tend to be an area more than a level. So I'm just going to keep these two. Okay, and then I'm going to look for a Fibonacci projection now. Now for Fibonacci projection, we use these 3 levels, 61.8, 78.6, and 100%. And I can see okay, even though my 61.8 lines up nicely with my first resistance, it's no longer valid because price has already cut through this level. So none of the levels are valid. I'm going to remove this. Okay, I think that's all the levels that we have. Okay, I'm just going to highlight this first support because we have a because price has tested this level multiple times in the past, and it also lines up with a 50%. Okay, so since price has broken this 23.6, I'm just now realizing this is no longer valid. So we're going to keep the 50%. Okay, so we can expect price to continue to drop down from here all the way downwards to our first support, and expect it to land maybe somewhere over here. Okay, so now that we have that, let's go in with our indicators. So we like to use Ichimoku and MACD because at one glance, you can see exactly what the signals are. Here for Ichimoku, you can see it's breaking into the cloud. Looks like it's about to break out of the cloud. Okay, so it gives us a little bit of a bearish signal, but since price hasn't broken out and moved under the cloud yet, we can't really say it gives us a bearish signal. So I'm just going to remove that so that we don't get confused. And then for our MACD, it's definitely giving us bearish. I'll take a look at another indicator. Okay, RSI is giving us a signal. Here is the level. Okay, this level over here, let me just highlight it, is this level here on the price chart. So we can see that where price is currently at is over here. But if we take a look at our RSI, this from here to here is obviously much steeper, whereas here we can see price is approaching our hidden support level here. Okay, so we can expect price to continue to drop towards this support level before reversing off of it. So it's likely to continue to drop. Okay. Any questions on pound dollar? Next, we'll be looking at gold. Okay, if all good, then let's get into gold. Excuse me, the weather is getting really cold, so I'm not feeling too well nowadays. Okay, so here we have gold on the weekly time frame again. We can see price is generally moving upwards on our weekly time frame, on our daily time frame as well. I think we have a trend line here. No. Perhaps a channel. Yeah, we have price moving within this ascending channel on our daily time frame. So both weekly and daily giving us very bullish signals. Okay, and now let's get into our 4-hour time frame. Okay. So first things first, we're going to see if we have any trend lines or trend channels. Okay, no trend line. Okay, we have a bit of a trend channel here. Okay, we have a bit of a trend channel here. Okay, so for a valid trend channel, we want to remember that we need to have 2 touches on top and 2 touches below. Okay, next we are going in with our support and resistance levels now. So just as a general rule of thumb, your first resistance would tend to be the first swing high to where price is currently at, and then we want to try and pull it back as far as we can without cutting too many bodies of candlesticks. So in this case, cutting just the wicks is fine, but you don't want to be cutting too many candlesticks, the bodies of the candlesticks. Okay, here's the first resistance. Next, our support. Same thing, we're going to try and pull it back. Okay, here's our first support. And then our second support is over here. Okay, this is just solely graphical. Like I mentioned, we will adjust these later on. Okay, now let's go in with our Fibonacci levels. Okay, I can already see this 50% lining up nicely. Let's see if the 61 also lines up. 50. Okay. So I'm just going to leave that there first. And then now I'm going to take a look and see if we have another retracement here. Okay, we have a 23.6 as well as the 61.8 that line up really nicely with our first and second support. Okay, now let's see if we have any projection levels. Okay, my 61.8 lines up nicely. So remember, for a Fibonacci, we want to look for this like flash kind of shape. Okay. I think that's all the levels that we have. Okay, remember when you're using Fibonacci, you want to make sure that you're following the shape as well. That's why I started my retracement from here so that it follows the shape, because there is a little bit of a gap here. Okay, I think that's all the levels we have. So, but I have one more level I want to take note of. Right over here at this, we have two swing lows here. Okay, and we can see price has tested this level many times. And it also lines up nicely with our 61.8. So I'm gonna take note of that level as well. Okay. Now let's go in with our indicators. Price is moving above the Ichimoku cloud, giving us bullish signal. MACD as well. Maybe RSI. Okay, RSI also moving in a really nice ascending trend line. So this overall is a very bullish chart for gold. But because this first resistance here, this first resistance is in line with a 50% Fibonacci retracement, and it is also a overlap resistance, which means price has tested this level many, many times. You can see the swing lows here as well as the swing highs here. So that's why we are seeing a bit of resistance over here. Okay, but with all of the upward pressure that we see from the ascending trend channel, price moving above the Ichimoku cloud, the MACD, as well as the RSI, all of our indicators are giving us a bullish signal. It's our second resistance. And it's likely that it will move within this ascending trend channel as well. Okay. I hope that was clear. I think we have time for one more chart. So if there are any requests, let me know in the chat. Hi, Kamya. Yep. So this is the news trading webinar. But we've gone through the slides on the trading strategy that you can use if you're trading the news. But we are currently looking at some setups. If you've missed the slides, this webinar is recorded, so I think you can email IronFX regarding the recording, or maybe you can take a look at YouTube. I'm not so sure if it will be uploaded soon. Yeah, but you can take a look there as well. Okay, no worries. Okay, if there are no requests, maybe we'll just take a look at one of the major currency pairs before we end the webinar. Okay, so we've done pound dollar. Maybe take a look at dollar yen. Okay, so same thing, we're gonna look at the higher time frames first. You see, there is a general upward trend on the Japanese yen on our daily time frame as well. Yeah, we have this ascending trend line here. I think we even have a channel. Yeah, okay, we have this channel as well. Okay, now let's take a look at our 4-hour time frame. Okay, so my first resistance will be over here. First support here. And then my second support just over here. Okay. So now I'm gonna go in with my Fibonacci levels. Okay, none of these levels really line up with any of my levels, so I'm just gonna get rid of it. Okay, maybe here. Okay, we have the 38.2. That lines up nicely with my first resistance. I'm gonna pull up my projection. Okay, my 61.8 lines up with my first resistance, so I'm just gonna keep that. Okay, and then okay, I guess my 50% also lines up with my first resistance, so I'll just keep that. Okay, I think that's all that we have. So let's quickly look at some indicators as well. Okay, price looks like it's approaching, it looks like it's going to break into the Ichimoku cloud. But it hasn't yet, so it's still giving us a bearish signal. So I'm gonna remove that. Price on our MACD giving us a bullish signal. And on our RSI as well. Okay, let me show you guys what I mean. So okay. So on our RSI, okay, on our RSI, we have these 2 points. These 2 points here. Price making a higher high on our RSI, but on our price chart, it kind of looks about the same at our second support. So this is what we call a bullish divergence, and that's how we know that price is likely to continue to increase with all of the upward pressure. Okay, so we are expecting price to continue to go up to our first resistance. But let me just highlight this first resistance is a confluence area because we have two Fibonacci levels, the 61.8 and 50%, along with a really, okay, not that strong because it only has one swing high resistance and a pullback resistance level. So it is still kind of strong, but it doesn't have multiple swing high levels or overlap levels. But that in combination with the two Fibonacci levels makes it a strong confluence area. So we can expect price to reverse off of the first resistance. Okay. As of now, we will continue to expect it to rise to our first resistance. Okay, let me know if there are any other questions. If not, you guys can leave the webinar. Thank you guys so much for joining me today. I hope you guys found it helpful, and I will see you guys next week. Bye!
Hello, my name is Christina, and today I will talk about GDP. Gross domestic product is the monetary value of all goods and services produced in a nation during a given time period, usually a year. Basically, it's a record of everything bought for money during the course of 1 year. Consumer purchases from a chocolate to a car and counted in the GDP. When businesses buy computers or export goods overseas, the transactions all increase the GDP. Government spending also contributes to the GDP. A related statistic is the GDP growth, which is a percentage that shows how fast the economy is growing. If the annual rate of GDP growth is 3%, that means the economy is 3% larger than it was the previous year. The rate of GDP growth changes depending on the health of the economy. During an economic downturn, the economy contracts and GDP declines. For example, the recession that lasted from 2007 to 2009 was a severe period of economic decline. A GDP figure that shows strong economic growth means that businesses are making money and can hire people. Unemployed people are more likely to find a job and consumer spending rises, leading to more profit for businesses and even more hiring. Government leaders analyze GDP reports when creating economic policy. The US Central Bank, the Federal Reserve, uses the GDP report to gauge economic activity. Investors look for signs of sustainable economic growth in the GDP report, paying close attention to the information it contains, especially corporate profits. Business leaders analyze the economy's performance as is reflected in the GDP report so they can decide on future investment and production. As a measure of the sheer size of the economy, the GDP provides economists and ordinary citizens alike with a convenient and accurate measure of economic vitality or the lack of it. Thank you for watching.